Hi, and welcome to our market view presentation. Today here we have Nicholas on my right, Thomas on my left, and I'm Dario. Today we'll be discussing and comparing the Australian dollar to the US dollar, with Nicholas here talking about the relative inflation, followed by Thomas here talking about the Australian current account deficit and the exchange rate expectation. Finally, we'll be discussing and comparing the Australian dollar to the British pound, with Nicholas discussing inflation, followed by me talking about the interest rate concluded by a forecast.
According to the World Bank, as shown by this graph, currently Australia has a higher inflation rate than that of the United States. As a result, there will be a decrease in the demand for the Australian dollar, as our weaker dollar becomes less competitive in the global markets for purchasing commodities and resources. This, in turn, will cause a drop in the demand for the Australian dollar, shifting the demand curve over to the left-hand side. This also causes an increase in the supply for the Australian dollar, as the lower demand will cause the supply curve to be pushed to the right-hand side, as an excess of currency starts to pile up from those who don't wish to use our currency. This will likely cause a negative effect on the overall pricing of the Australian dollar.
Hi, I'd like to start by looking at the current account. So we can see the slides here. The Australian current account deficit is up to 0.6 billion. And this is issued by Australian Bureau of Statistics on 6 September 2016. As we know that the current account is a balance of trade between a country and its trading partners, if reflecting all the payments between the countries for goods, services, interest, and dividends. So in this case, a deficit in the current account shows that the country is importing goods and services more than it's exporting. So Australia will then borrow capital from the foreign sources to make up the deficit, and that will cause Australian dollars to depreciate relative to the trading partners like the United States. So now let's move on to the next indicator, which is exchange rate forecast. So here we can see from the graph, we have our exchange rate forecast provided by National Australian Bank. And from this little chart, we can see that exchange rate decreases from 0.77 in September 2016 to 0.7 in September 2017. So obviously, the National Australian Bank thinks the exchange rate of Australian dollars against USD is going to fall. And about exchange rate expectations, we have to notice the self-fulfilling effect, which is, in this case, the market participants expect the future value of the Australian dollars to fall. Thus, people is going to sell the Australian dollars because it becomes worthless, and then it will increase the supply of the Australian dollar in the foreign market, and that will cause a fall in its value. So Australian dollars depreciates against USD. So basically, the two indicators I just mentioned, the exchange rate expectations and current account deficit, these two showing that Australian dollars is going to depreciate against the USD.
As indicated by the two graphs, according to the World Bank, currently Australia has a higher inflation rate than that of Great Britain. Normally, this would cause a decrease in the demand for exports, as the Australian dollar becomes less competitive in the global market while purchasing resources and commodities. Hence, this would cause a decreased demand on the Australian dollar, shifting the demand curve over to the left-hand side, while simultaneously causing an increase in the supply of the Australian dollar, shifting the supply curve to the right. However, in light of the recent Brexit vote, the British inflation rate has risen to a new high since November 2014. If this trend continues and our inflation rate stays stable as it has been stated to be in the past few months by the Reserve Bank of Australia, this should have a minor positive influence on our Australian dollar when compared to the British pound.
The interest rate in Australia is set to 1.5% by the Reserve Bank of Australia, while the UK interest rate is set to 0.25% by the Bank of England. The traditional view is that compared to the UK, Australia has a higher interest rate. An increase in interest rates would encourage capital inflow, increasing demand for AUD, as well as discourage capital outflow, decreasing the supply of AUD, henceforth causing the AUD to appreciate compared to the British pound. However, empirical evidence suggests high nominal rates usually reflect high inflation rates, and thus this would lead to a depreciation as a result of high inflation. As it stands, the Australian interest rates have been unchanged in the past month, while the UK interest rates were last changed following the Brexit vote from 0.5% to 0.25%. Surprisingly, this is the lowest the UK's interest rates have ever been in history. For the forecast, due to the recent events, there is uncertainty involved with the UK and its British pound. The aftermath of Brexit is still felt by the UK, with interest rates dropping and expected to drop even further. Considering this, I believe the AUD will appreciate compared to the Great British Pound. This is also supported by the fact that the interest rate and inflation rate in Australia are low and barely move. And thank you for watching our market view presentation.